We're in very early days in terms of AI and its impact on the global economy. If you think in terms of internet time, we're in the early 90s, if not before. So just want to state that out. What they call it, the $600 billion question, I think it is. Who's going to make the money off of AI? Or is this going to be just completely commoditized, given how much capital is being thrown at this form of innovation? Well, we're getting some clues as to where we are in this earnings season. So we thought we'd share some thoughts around NVIDIA and some other companies that are giving us a sense of how this world is going to evolve. And it's very fluid. And as I said, very early days. But we think we're at the beginning of one of the most fantastic technology journeys in history.
Don't forget to subscribe, traders. Let's continue with the interview to analyze it later and also comment on some of the most important news of the day.
Interestingly, you see that M2's growth has moved from negative into positive territory, but is still very low by historical standards. That's the purple line. In the green line, you can see the CPI, which it's not a perfect correlation by any means, but you can see the message from this chart. Because the money supply growth rate has moved forward. The message is inflation is probably going to drop. Let's see, the CPI is on the left-hand scale here, into the 1% to 2% range. And we would not be surprised to see it go negative as we did in 2020. And we saw in 2014 and 15, and even before that in 08, 09. So we think that will happen again, and that the Fed is going to be easing aggressively before all is said and done. And on this next page, here I've presented the yield curve for many months now. And you can see the yield curve had been flattening and then inverted. And has been doing so really since 08, 09 in a trend sense. But you see what happens after an inversion and a move back above zero so that short rates are below long rates. What does that typically portend? It usually means we're in a recession. You can see the shaded lines are a recession. You can see we had gone inverted. It doesn't show here. You can barely see. We inverted for a few months in 2019, and we didn't know about COVID, and we'll never know if the inversion was an indicator that a recession was going to take place. But we did end up in a recession. Here in 08, 09, moved positive. We were moving into a recession. Here we were in the recession in the tech and telecom bust. We were in the recession during the S&L crisis. We were in the recession as Volcker was trying to starve the economy of money to squelch inflation.
Recent economic trends have shown intriguing developments, particularly in relation to inflation and the broader financial landscape. One key indicator is the growth of M2, a measure of the money supply that includes cash, checking deposits, and easily convertible near money. After a period of negative growth, M2 has shifted to positive territory. This change may signal a slowdown in inflation as the money supply begins to stabilize, which typically helps alleviate upward pressure on prices. In line with this, there is growing speculation that the Consumer Price Index (CPI) could see a reduction, potentially falling within the 1% to 2% range. In fact, there is even the possibility that inflation could turn negative, a phenomenon not unfamiliar in recent years when deflationary pressures briefly emerged. Adding to the complexity of the current economic landscape is the behavior of the yield curve. The inversion of the yield curve, when short-term interest rates rise above long-term rates, has long been regarded as a reliable predictor of an impending recession. Historically, whenever this inversion occurs, a recession usually follows. Given that the yield curve has been inverted for some time, it raises concerns that we may already be in the early stages of a recession. While these economic signals point to potential challenges ahead, they also suggest that inflationary pressures could continue to ease, offering some relief in terms of price stability. However, the interplay of these factors will require close monitoring as the economy navigates the potential risks and opportunities that lie ahead.
So we're probably in a recession, and we probably, by some metrics, we have been in a recession for some time. Rolling recession, I know I've been saying for a long time, housing went down immediately and is actually in a depression. But we do think that's a rubber band stretching, and that's why we don't think that this recession is going to be that bad. It could actually end quite quickly if we get those interest rates down and get the cyclical sectors of the economy cranking again, with so many people waiting on the sidelines, especially for housing, new and existing homes. But anyone who faces price deflation, and we think many companies will, is going to adopt new technologies that are going to increase their productivity dramatically. And that is what always happens during a recession. Innovation gains traction. Consumers and businesses are willing to change the way they do things when they're fearful. And we think they're getting fearful. So we think there's going to be a lot more technology adoption, especially around AI during the years ahead. So I'll end up where we started. We're in very, very early days with AI. We think it's the most important general purpose technology transformation in history, and that it has miles to go. And the rate of change is so much faster.
During times of economic recession, when companies are confronted with price deflation, the adoption of new technologies often becomes a key strategy to enhance productivity and maintain competitiveness. These periods of economic downturn place significant pressure on businesses to cut costs while trying to improve output, and technology offers a promising solution to achieve these goals. Specifically, advancements in areas such as automation, data analytics, and artificial intelligence (AI) are increasingly seen as essential tools for businesses to navigate the challenges posed by recessions. By adopting these technologies, companies can streamline their operations, reduce human error, and ultimately improve efficiency in ways that might not have been possible using traditional methods. Among these emerging technologies, artificial intelligence stands out as a particularly transformative force. AI is widely regarded as a critical general-purpose technology that has the potential to redefine industries across the board. As companies face the economic pressure of a recession, AI offers opportunities for deeper insights through data-driven decision-making, automation of routine tasks, and the optimization of complex processes. The rapid pace of AI development suggests that we are on the brink of significant advancements in this field, which could fundamentally change how businesses operate in the near future. As more companies adopt AI and other innovative technologies, we can expect a shift in how they respond to economic challenges, prioritizing efficiency and innovation to stay competitive in an increasingly complex global market.
Than it was during the internet age, which was all around Moore's Law, which was, in the transistor world, semiconductor world, same performance for half the cost every 18 to 24 months. Today, the changes are not happening in 18 to 24 months. The performance changes for the same cost, they are happening every 4 months. And that's why we think it's important for, anyone, whether you're an employee or a business leader, to think about embracing as many of these, or harnessing as many of these AI tools to increase productivity as possible, because the competition is going to be very intense. Those who adopt these new technologies the fastest are going to win.